Hey everyone, welcome back to the channel. Today we're diving into the legendary wisdom of Charlie Munger, Warren Buffett's right-hand man at Berkshire Hathaway. You know, the guy who eats McDonald's every day and still managed to build a multi-billion-dollar empire. Munger once shared how to achieve 50% annual returns when investing small amounts of money. Now I know what you're thinking, 50% returns? That sounds insane. And you're right, it is insane, especially in today's market. But before you click away, hear me out. These lessons are pure gold for anyone serious about building wealth, whether you're starting with a few $100 or a few thousand. So grab a notebook because this video could change how you invest forever. Now before we jump into Munger's brilliant yet somewhat unconventional strategies, let's talk about why this works so well with smaller sums of money. It's crucial to understand the dynamics at play here. You see, when you're dealing with millions or billions, you're pretty much stuck with the big players in the stock market. The sheer volume of money forces you into the same lanes as the institutional giants. You're forced to play it safe, diversify like crazy, and hope for those steady but frankly kind of boring 8 to 10% returns. It's a game of minimizing risk rather than maximizing potential. But when you're starting small, you have this incredible advantage: agility. You can maneuver through the market with a level of flexibility that large funds simply can't match. You can dart in and out of positions quickly, take calculated risks that would make a hedge fund manager faint, and most importantly, you can tap into the power of inefficient markets. These are the markets where information asymmetry can be your best friend. Think of it like this. The stock market is like a giant ocean liner. It's vast, powerful, but also slow to change course. It's massive, slow to turn, and pretty much goes wherever the big institutions steer it. The inertia of large capital flows dictates its direction. That's your S&P 500, your index funds, your safe and steady investments. These are the behemoths of the investment world, providing stability, but not necessarily excitement. But, just like the ocean has hidden coves and inlets teeming with unique and often overlooked treasures, the stock market has its own hidden gems. These are the places where the big money doesn't venture. These are the inefficient markets, the smaller, less hyped areas where big money simply can't be bothered to go. They are often ignored due to their size or perceived risk. These are the micro-cap stocks, the foreign markets, the niche industries that Wall Street overlooks. They fly under the radar, away from the spotlight. And guess what? These overlooked corners are often where the real opportunities for explosive growth lie hidden. They are the fertile grounds for those willing to dig deeper. Now, I'm not saying you should throw all your money into some random penny stock you found on Reddit. That's a gamble, not a strategy. That's a recipe for disaster, not investing. It's crucial to differentiate between speculation and informed investment. But if you do your research, if you understand a particular market better than the average investor, you can find incredible opportunities that the big guys simply miss. Knowledge and insight become your competitive edge. This is where your small size becomes your superpower. You can act swiftly and decisively. You can move quickly, invest strategically, and potentially reap massive rewards. The agility of a small investor can lead to outsized gains. Remember, the goal here isn't to gamble. It's to find undervalued assets in markets where information isn't flowing as freely. These are the markets where your research can uncover hidden value. Think about it. Real estate in emerging markets, small businesses with disruptive technologies, even collectibles with a dedicated following. These are areas ripe with potential. These are all examples of potentially inefficient markets where you can find incredible deals if you know where to look. The key is to be diligent and thorough in your research. The key here is to become an expert in your chosen niche. Specialization can lead to significant advantages. Read everything you can, talk to people in the industry, understand the risks and the potential rewards. Networking and continuous learning are essential. Knowledge, my friends, is your most valuable asset in these waters. The more you know, the better equipped you are to navigate these markets. Remember, the big institutions, they're playing a different game. Their strategies are built around scale and risk management. They're focused on managing risk across massive portfolios. Their size limits their flexibility. You, on the other hand, you have the freedom to be nimble, to be opportunistic, and to potentially achieve those outsized returns that most people only dream of. Embrace your agility and use it to your advantage. Alright, so we've talked about finding those hidden gems in inefficient markets. Now let's talk about what to do when you find one swing for the fences. I know, conventional wisdom says to diversify, to spread your risk across a bunch of different investments. And while that's not bad advice in general, especially if you're aiming for slow and steady growth, it's not how you achieve those life-changing returns. Charlie Munger and his partner in crime Warren Buffett, they didn't get rich by dipping their toes in the water. They made bold bets, concentrated their investments, and swung for the fences when they saw an opportunity they believed in. Now, I'm not saying you should put all your eggs in one basket, that's just reckless, but if you've done your research, if you truly believe in an investment, don't be afraid to go all in. Remember, we're talking about small amounts of money here. So even if things go south, even if you lose it all, it shouldn't cripple you financially. And that's the beauty of starting small. You have the freedom to take risks that you wouldn't even consider with larger sums. Think of it like this. Would you rather invest $1,000 in 10 different stocks hoping to eke out a 10% return? Or would you rather invest that same $1,000 in one or two carefully selected opportunities that have the potential to double, triple, or even 10 times your money? The answer seems pretty obvious, right? But here's the thing. Most people are too afraid to take that leap. They're too worried about losing their hard-earned money. And that fear, my friends, is what keeps them stuck in mediocrity. Look, I'm not saying it's easy. Taking big swings requires conviction, it requires discipline, and it definitely requires a strong stomach. But if you want to achieve extraordinary returns, you have to be willing to step outside your comfort zone. Now, before you run off and bet your life savings on some meme stock, remember, this isn't about gambling, it's about calculated risk-taking. It's about identifying asymmetric opportunities where the potential upside far outweighs the downside. And that's where your research comes in. You need to understand the business, the industry, the competitive landscape, and the potential risks before you even think about going all in. But once you've done your due diligence, once you've convinced yourself that this is an opportunity you can't miss, don't be afraid to bet big. Remember, fortune favors the bold, especially in the world of investing. So, take those big swings and who knows, you might just hit a home run. Okay, so we've talked about finding those hidden gems in inefficient markets. And we've talked about taking big swings when you find them. These are crucial steps in building a successful investment strategy. Now, let's talk about the final piece of the puzzle, focus. This is often the most overlooked aspect, yet it can be the most transformative. You see, one of the biggest mistakes I see investors make, especially when they're starting out, is spreading themselves too thin. They get overwhelmed by the sheer number of options available. They diversify into a million different things, thinking that's the key to mitigating risk. They believe that by spreading their investments, they are safeguarding their portfolio. And while diversification is important, especially as your portfolio grows, it can actually work against you when you're starting small. The impact of each individual investment becomes negligible. Why? Because it dilutes your returns. Your gains are spread too thin across too many investments. Think about it. If you have $10,000 to invest and you spread it across 20 different stocks, even if one of those stocks doubles, it's only going to move the needle a tiny bit on your overall portfolio. The impact is minimal and often disappointing. But if you take that same $10,000 and invest it in just one or two of your absolute best ideas, the ones you've thoroughly researched and believe in, the potential upside is exponentially greater. The returns can be significant and life-changing. This is what Charlie Munger calls focused investing. It's a strategy that has been proven to work by some of the greatest investors of our time. It's about identifying your absolute best ideas, the ones you believe in with every fiber of your being, and then putting your money where your mouth is, and then concentrating your resources on those opportunities. This requires conviction and confidence in your research and decisions. Now, I know this goes against everything you've probably heard about investing. It challenges conventional wisdom. Diversification is supposed to be the holy grail, right? It's the mantra repeated by financial advisors everywhere. And it is, to a certain extent. Diversification does have its place, especially as your portfolio grows and you need to manage risk. But when you're starting small, focus is your superpower. It's the tool that can set you apart from the average investor. Think of it like this. Would you rather be a jack of all trades, master of none? Spreading yourself too thin can lead to mediocrity. Or would you rather be a master of one? Specialization can lead to excellence and extraordinary results. In the world of investing, being a master of one or a few carefully selected investments can lead to extraordinary results. This focused approach can yield significant returns. Now, this doesn't mean you should put all your money into one stock and call it a day. That would be reckless. You still need to diversify to some extent, especially as your portfolio grows. Balance is key, but the key is to focus on your absolute best ideas, the ones that stand out after thorough research and analysis, the ones you believe in more than anything else. This belief and confidence are crucial. This is where your circle of competence comes in. Knowing your strengths and areas of expertise can guide your investment decisions. What are you truly passionate about? Passion can drive deeper understanding and better investment choices. What industries do you understand better than anyone else? Your unique knowledge can give you an edge. What are your unique insights that give you an edge in the market? These insights can be your competitive advantage. These are the questions you need to ask yourself when building a focused portfolio. Self-awareness and strategic thinking are key. Remember, you don't need to be an expert in everything. In fact, trying to be can be counterproductive. In fact, it's better if you're not. Specialization allows for deeper knowledge and better decision-making. The goal is to find your niche, your area of expertise, and then dominate that space. This focused approach can lead to superior results. By focusing your time, energy, and resources on a select few opportunities, you can maximize your potential returns. You're essentially putting all your eggs in baskets you've meticulously crafted yourself. These are baskets you understand and believe in. You understand the risks, you believe in the potential, and you are prepared for the outcomes. And you're willing to bet big on your own judgment. This confidence can lead to significant rewards. This is how Charlie Munger and Warren Buffett built their fortunes. Their focused approach set them apart. They didn't get rich by following the herd, they carved their own path. They got rich by thinking differently, by challenging conventional wisdom, by focusing on their best ideas, and by having the conviction to bet big when the odds were in their favor. This strategic focus is what made them successful. And by having the conviction to bet big when the odds were in their favor, this strategic focus is what made them successful. To recap, here are Munger's 3 rules for investing small amounts of money. 1. Look for opportunities in inefficient markets. 2. Take bold action when the right opportunity arises. 3. Focus your portfolio on what you know best. These strategies might go against conventional advice, but if you want to achieve extraordinary returns, following Charlie Munger's wisdom is a great place to start. Make sure to like this video, subscribe to the channel, and let me know in the comments which of these lessons resonated most with you. Thanks for watching, and I'll see you in the next video.